Something changed in the gold market that hasn't happened in half a century. Not a rally, not a correction, a structural break. The kind of move that does not reverse because it reflects a system-level shift that's already locked in. Gold just severed its correlation with real interest rates, a relationship that has governed its price behavior since 1971. And if you don't understand what that means, you're about to watch the largest wealth transfer in modern history happen in front of you while everyone else is still checking the Fed's next rate decision. For 50 years, gold moved opposite to real yields. When real interest rates rose, gold fell. When they dropped, gold climbed. It was mechanical, predictable. The entire pricing model for the metal was built on this inverse relationship. Analysts, funds, central banks, all of them use this correlation as gospel. It worked through stagflation, through the dot-com bubble, through 2008, through COVID, until now. In 2022, real yields spiked to levels not seen in over a decade. Gold should have collapsed. Instead, it stabilized. Then, in 2023, as real yields stayed elevated, gold didn't just hold, it rallied. By early 2024, gold was hitting all-time highs, while real interest rates were still deeply positive. That's not supposed to happen. That's not a deviation, that's a break. And the break isn't temporary, it's structural. Because the buyers driving this move aren't the ones who care about yields. Central banks are buying gold at a pace the world hasn't seen since 1950. In 2022, they added over 1,100 tons. In 2023, they shattered that record. China, Russia, India, Turkey, Poland, Singapore, they're all accumulating. Not rotating, not diversifying. Accumulating. And they're not doing it because gold hit a technical level or because some analyst upgraded it. They're doing it because the system they've relied on for 70 years is fragmenting, and they know it. Here's what's not being said clearly enough. These aren't speculative buyers. Central banks don't buy gold to flip it. They buy it because they've lost confidence in the alternative, which is holding someone else's liability as a reserve. For decades, that liability was the U.S. Treasury bond, backed by the dollar, backed by the perceived stability of American fiscal and monetary policy. But perception is cracking. The U.S. debt to GDP ratio is now above 120%. Interest expense on that debt is over $1 trillion a year. That's more than the defense budget, and it's compounding. When a central bank in Asia or the Middle East looks at that math, they're not thinking about next quarter's inflation print. They're thinking about what happens in 10 years when the U.S. has to choose between paying bondholders or funding its government. They're thinking about currency debasement, not as a possibility, but as an inevitability. And gold is the only asset with no counterparty risk. It's no one's liability. It can't be printed. It can't be sanctioned. It can't be frozen. And that matters now in a way it didn't 5 years ago. Look at what happened after Russia's foreign reserves were frozen in 2022. Over $300 billion held in dollars and euros, locked, unusable. That wasn't a military action. That was a financial one. And every central bank on the planet watched it happen and understood the message. Holding reserves in another country's currency is a privilege, not a right. And privileges can be revoked. So they're moving into the one asset that doesn't require permission to own or use: gold. But it's not just central banks. There's a second wave of buying that almost no one is talking about, and it's bigger. Sovereigns, not central banks. Sovereign wealth funds. The pools of capital controlled by nations with energy surpluses, trade surpluses, and long-time horizons. These are the entities managing trillions in assets, and they're shifting. Quietly, not through headlines, but through positioning. They're rotating out of duration risk, out of long-dated bonds, and into hard assets. Gold is at the top of that list. Why? Because they're watching the same fiscal math everyone else is ignoring. The US, Europe, Japan, all running deficits that require continuous debt issuance at a scale that's unprecedented in peacetime. And all of them are doing it in an environment where inflation is structurally higher than it was for the previous 40 years. That's not a cycle. That's a regime change. And in a regime where inflation stays elevated and real rates stay suppressed, bonds lose. Gold wins. Now here's the part that is going to separate the people who understand what's happening from the people who are still waiting for confirmation from CNBC. The break in the correlation between gold and real yields isn't happening because gold suddenly became irrational. It's happening because the market is repricing gold against a different variable. Not yields, not inflation expectations, trust. Or more specifically, the collapse of trust in the long-term stability of fiat reserve currency systems. That's not a headline you'll see in the Financial Times. It's too abstract, too uncomfortable. But it's what the price is telling you. Gold is no longer being priced as an inflation hedge or a safe haven for the next recession. It's being priced as a monetary alternative for a world where the existing monetary system is under structural strain. And once that repricing starts, it doesn't stop until there's a resolution. And resolution, in this context, means either a return to sound fiscal policy or a complete loss of confidence in paper currencies. One of those is politically impossible. The other is mathematically inevitable. Let's go deeper into the mechanism. For 50 years, gold's price was suppressed by a very simple dynamic. When real yields were positive, meaning you could buy a government bond and earn more than inflation, gold had opportunity cost. You could own gold and earn nothing, or own a bond and earn a real return. For most investors, that made bonds the rational choice. But that logic only works if you trust the bond will be repaid in currency that holds value. And that trust is breaking. Here's what the market is quietly pricing in. The Federal Reserve, the ECB, the Bank of Japan, they're all trapped. Inflation is structurally higher because of supply-side constraints, demographic shifts, and energy transition costs that aren't going away. But debt levels are so extreme that raising rates to truly crush inflation would trigger a debt crisis. So they're stuck in a corridor. Rates high enough to hurt growth, but not high enough to restore price stability. And in that corridor, real yields might stay positive on paper, but they stay negative in practice because inflation stays elevated and volatile. That's the environment where gold breaks the old correlation. Because in that environment, holding bonds isn't safe. It's slow confiscation. You're earning 4% while inflation runs at 3.5% and your purchasing power erodes every year. Meanwhile, gold holds value because its supply is fixed. It can't be debased. It can't be policy adjusted. It just sits there, doing what it's done for 5,000 years. And the longer central banks stay trapped in this corridor, the more capital flows into gold. Now let's talk about what happens next, because this is where most people get it wrong. They assume gold's rally will pause when the Fed cuts rates or when inflation comes down, but that's backward. The rally isn't driven by inflation or rate cuts. It's driven by accumulation from buyers who aren't sensitive to short-term price moves. Central banks don't stop buying because gold went up 20%. They stop buying when they have hit their allocation target. And right now, most of them are nowhere near their targets. China is the clearest example. The People's Bank of China has been adding gold to reserves every single month for over a year. Not sporadically, every month. And their gold to GDP ratio is still below 4%. Compare that to the US at over 8% or Germany at over 10%. China has room to triple their gold reserves and still be below Western averages. And they're not alone. India, Russia, Turkey, they're all in the same position. Underweight gold relative to historical norms and buying aggressively to close the gap. Here's the math that matters. If the top 10 central banks outside the US and Europe increase their gold reserves to just match the average of developed economies, that's over 10,000 tons of demand. At current annual mine supply of around 3,500 tons, that's 3 years of global production. And that's assuming nobody else buys, which they will. Because once the repricing starts, it accelerates. Not because of speculation, but because of positioning. Every central bank that doesn't own enough gold becomes relatively weaker, and weakness in the reserve currency game is existential. Now add the private sector. Not retail, not gold bugs, institutional allocators, pension funds, endowments, family offices. These are the entities managing generational wealth, and they're starting to ask a very simple question. If central banks are buying gold at record levels, what do they know that we don't? And the answer is becoming obvious. They know the fiscal math doesn't work. They know the debt spiral is accelerating. They know that at some point there will be a choice between austerity and debasement. And they know which one politicians will choose. Here's where it gets uncomfortable for most people. The institutions telling you gold is overvalued, the ones publishing research with price targets based on the old correlation models, they're the same institutions that are underweight gold. They have to talk it down because they're positioned wrong. But their central bank clients aren't listening. Their sovereign clients aren't listening. Because those clients have access to the same data, and they're drawing a different conclusion. They're concluding that the era of dollar dominance is ending, not in a dramatic collapse, but in a slow, grinding erosion of trust. And gold is the only asset positioned for that outcome. Let's talk about what the break in correlation actually means for price. Now layer in the supply side. Gold production has been flat for 5 years. New discoveries are declining. Development timelines are stretching. Costs are rising. The easy gold is gone. What's left requires deeper mines, lower grades, higher energy input. And energy is expensive now. That sets a floor under the cost of production, which sets a floor under price. And that floor is moving up, not down. At the same time, demand is exploding. That's not a setup for a pullback. That's a setup for a melt-up. But here's the part that's hardest to grasp for people trained in traditional finance. The melt-up won't look like 1980. It won't be a speculative frenzy driven by retail investors buying coins and futures. It will be a quiet, relentless grind higher, driven by institutional and sovereign accumulation. No fireworks, no mania. Just month after month of central banks adding tonnage and the price slowly compounding. And by the time the mainstream catches on, the move will be over. Not because gold crashed, but because it stabilized at a level that reflects its new role in the monetary system. Let's address the objection everyone's thinking. What if the Fed pivots and cuts rates aggressively? Won't that strengthen bonds and pull capital out of gold? No, because the reason the Fed would cut aggressively is either a recession or a debt crisis. In a recession, gold rallies as a safe haven. In a debt crisis, gold rallies because it's the only asset with no credit risk. Either way, gold wins. The old playbook, where rate cuts meant risk on and gold sold off, that playbook is dead. It died when fiscal dominance replaced monetary dominance. The Fed no longer controls the narrative. The Treasury does, and the Treasury needs low rates to service the debt. That's the new regime. Here's the darker scenario almost no one is pricing in. What if the break in correlation isn't just about trust in fiscal policy? What if it's about trust in the currency itself? Not hyperinflation, not a collapse. Just a slow realization that the dollar's purchasing power is going to erode faster than official inflation data suggests. Because the way inflation is measured has been adjusted, revised, and smoothed to understate the real loss of purchasing power. Shelter costs are lagged. Energy is stripped out. Substitution effects are assumed. The CPI is a political construct, not an economic one. And people are starting to notice. When they notice, they don't panic. They just shift. They move wealth out of cash and short-term bonds and into assets that can't be debased. Real estate, commodities, equities with pricing power, and gold. Especially gold, because it's liquid, portable, and universally recognized. And once that shift starts, it doesn't reverse, because it's not based on a forecast. It's based on experience. And experience, once learned, is hard to unlearn. Now let's talk about what this means for the global monetary system. The dollar's role as the reserve currency was never guaranteed by law. It was guaranteed by trust, by the size of U.S. capital markets, and by the lack of alternatives. But all three of those pillars are weakening. Trust is eroding because of fiscal recklessness. Capital markets are fragmenting because of sanctions and financial weaponization. And alternatives are emerging. Not a single alternative, but a multipolar system where different regions use different settlement mechanisms. And in a multipolar system, gold becomes the neutral reserve, the only asset every country accepts without question. That's not speculation. It's already happening. Central banks are settling trade imbalances in gold, not officially, not through press releases, but through quiet accumulation and bilateral agreements. The Bank for International Settlements has facilitated gold swaps. The Shanghai Gold Exchange is pricing in yuan, not dollars. The writing is on the wall. The dollar will remain dominant for years, maybe decades. But its monopoly is over, and in a world without a monopoly reserve currency, gold's value isn't determined by U.S. interest rates. It's determined by global demand for a neutral, non-sovereign store of value. Here's the psychological shift that's hardest to make. For 50 years, we've been conditioned to think of gold as a relic, a barbarous artifact that only matters during crises. But that framing was deliberate. It was promoted by central banks that needed people to hold their bonds and their currencies. Because if capital flowed into gold, it wouldn't be available to finance government deficits. But now, the central banks themselves are buying. That's not a crisis hedge. That's a structural allocation. And when central banks structurally allocate to gold, they're telling you they don't believe their own narrative anymore. The media won't frame it that way. They'll call it diversification. They'll say it's about geopolitics. They'll avoid the obvious conclusion, which is that central banks are preparing for a world where fiat currencies are less stable, less trusted, and less dominant. And preparation at the central bank level takes decades. They're not buying gold for 2025. They're buying it for 2040. And they're buying it now because they know the best prices are behind them, not ahead. Let's bring this back to the title. Gold just broke a 50-year pattern. That's not hyperbole, it's a fact. The correlation with real yields is gone, the old models don't work, and the new model is being written in real time by the largest, most patient buyers in the world. Central banks, sovereigns, institutions with infinite time horizons and singular focus. They're not trading, they're positioning. And they're positioning for a world where the monetary system looks nothing like it did for the past 70 years. Now here's the final piece. The break in the pattern isn't the event, it's the signal. The event is what comes next, and what comes next is a repricing of every financial asset relative to gold. Not in nominal terms, but in real terms. Bonds will lose value in gold terms because their claims on depreciating currencies. Equities will be volatile in gold terms because their earnings are in depreciating currencies. Real estate will hold better, but only in regions with supply constraints. And cash will bleed, slowly, invisibly, the way it always does when trust in currency erodes. The people who understand this early won't panic. They'll adjust. They'll shift allocations. They'll recognize that the game changed, and they'll play the new game. The people who don't understand it will wait for confirmation. They'll wait for the media to tell them it's safe. They'll wait for their financial advisor to update the models. And by the time confirmation comes, the move will be priced in. Not because the market is efficient, but because the patient capital is already positioned. This is not about predicting a price target. It's about recognizing a regime change. The regime where gold was a hedge is over. The regime where gold is a monetary asset has begun. And in that regime, price isn't determined by inflation or interest rates. It's determined by flow. And the flow is one direction. Into gold. Out of paper. Quietly. Relentlessly. Irreversibly. The math is already locked in. The correlation broke because the system broke. And the system doesn't unbreak. It adjusts. An adjustment in a debt-saturated, fiscally insolvent, monetarily trapped global economy means higher gold prices. Not because of speculation. Because of necessity. Central banks need it. Sovereigns need it. And eventually, everyone else will realize they need it too. The 50-year pattern is gone. What replaces it isn't chaos, it's clarity. Gold is no longer an alternative asset. It's becoming the alternative currency. And the price shift isn't beginning. It already began. You're just watching it unfold. Now, here's the question you need to answer. If central banks are buying gold at record levels while telling the public everything is fine, what do you think they're preparing for? Drop your answer in the comments. Let's see who's paying attention. This is not financial advice. This is pattern recognition. And the pattern just told you everything you need to know.